For today's video, we will be going to talk about Peter Lynch explains how to invest during a correction. Let's get started. How do you invest in a market crash? A stock market crash happens when profits achieved over the previous few years are lost as a result of an abrupt decline in the markets. A billion capitalizations burn in a matter of weeks, days, or even hours or minutes, and many companies' share prices fall to extremely low levels. Market crashes are nothing new because they happen frequently. The Wall Street crash of 1929, Black Monday in 1987, the Nasdaq crash of 2000s, the stock market crash of 2008, and most recently, the COVID-accelerated crash of 2020 are some of the worst that has occurred in the past. For Peter Lynch, the Black Monday crash of 1987 is particularly significant. Let's look at what Peter Lynch says. Rule number 1, focus on company fundamentals, not on macroeconomic developments. The stock market is a wild beast. Not everything is under the control of the investor, and there are numerous variables that, like Mike Tyson's left hook, can knock you out from nowhere. Most investors make the mistake of concentrating solely on these global macroeconomic trends by focusing too much on them. Nowadays, people suffer from information crippling, a condition in which they have so much information about macroeconomic changes that it makes it difficult to make wise decisions. According to Peter Lynch, doing this is the surest way to ruin your investment portfolio. Lynch argues that the real focus of an investor should be on picking winning companies. Company fundamentals will rule over any other external factors in determining the value of equity security in the long term. Recognizing this crucial relationship could produce alpha rewards. Macroeconomic developments are intermittent and recurring factors that occur. Invest in companies that are strong in the industry, that interest you rather than trying to influence each other individually. One of the essential pillars Lynch has built his obviously successful career on is the art of investing in good companies and how to choose them. Because the companies in your portfolio have strong fundamentals, they can recover even in a market downturn and help your portfolio grow. Lynch's stock recommendations can provide significant insights into this. In essence, Rule 1 instructs investors to ignore the market's fluctuations. I am aware that doing this can be very challenging, given the regular news coverage of stock prices and market fluctuations that we receive. However, you must pay attention to business principles. An easy illustration of this is Apple, whose price has then risen since its epidemic low in March 2020. According to Lynch, good businesses with strong fundamentals consistently outperform macroeconomic developments. It's time to evaluate your investments in people and see what additional advice Lynch has for us. Rule number 2, winning is almost certain in the long term when the strategy is correct. It's important to have a long-term perspective while investing in the stock market. With anything less, you cannot endure in the markets. It is a grave error to pay excessive attention to short-term market swings and to act accordingly. Whenever asked about the proper method of approaching markets in the past, the stock market is not the place to be. According to Lynch, if you need money in the next 12 months to pay for a wedding or a down payment on a home, the direction the market will take in the upcoming year is a coin toss. We don't know if the Dow or Nasdaq will end the next 1,000 points in positive or negative territory. But if you're looking for the long-term 5, 10, or 20 years, you should stick to your long-term investing plan because time is in your favor. We contend that the market will rise the next 10,000 to 20,000 points. That has been the overall pattern. The bottom line is to know what you possess and why you own it, and to have a prudent investing plan. Too much is at risk for it not to. Any expanding economy's long-term trend is for the market to continue expanding. Lynch is unwavering in his belief that the stock market will rise in the long term, with a healthy selection of high-quality equities. There is only one way to go over the long term. This may not be true for every individual stock, but it is true for the market as a whole. In 1987, the year we discussed previously, the market experienced a crash known as Black Monday, with a 22% drop in the Dow Jones Industrial Average in a single day. Lynch retained his portfolio. Many investors went insane and started selling for a loss. The big stock market panic of 1987 was amusing, and those equities quickly rebounded past the previous zenith and didn't look back. At the height of the 1987 stock market meltdown, the Dow Jones Index was 1,833 points. By 1999, it has increased to 10,000 points. As Lynch noticed, the market can be erratic in the short term and may cause some havoc, but over the long term, it will always rise. It's important to keep in mind that long-term enterprises will always increase in value if we experience a crash and you have a diverse portfolio of businesses. Rule number 3, stop worrying about a market crash and its longevity. Another thing that Lynch addresses as a part of his key rules for investing is not to worry too much about a market crash, even when you're going through it. Lynch claims that constantly adjusting your portfolio to account for market declines and crashes is pointless. As investing involves risk, including market crashes, they should not interfere with your ability to invest in reputable businesses or have an impact on the expansion of your portfolio, because they have frequently occur to varying degrees. The market expanding, correcting, and moving even higher is a step in the growth process. It's essentially what is referred to as the business cycle impact. Moreover, it has been a component of the market for as long as the market has existed. It's pointless to stress over it. Lynch responded positively when asked in 1988 if there will be a recession in America. But why should we be concerned? Our recession was the worst since the crisis of 1982 to 1983. We experienced 15% inflation, 14% unemployment, and 20% prime rate. Stock market performance is perfect in the past 50 years of forecasting economic expansions. It has never been in error. In a slump, it's less than 50-50. A recession is forthcoming. Which aspect of this subject have you found to be very useful? Please let me know by leaving a comment below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.